So Nate, if I had to guess the interest rate, that's going to be a key part of virtually every conversation about rental financing. So peel back the onion a bit and tell me what goes into coming up with a rental loan interest rate.
Yeah, funny intro to this question here, Dalton, because you're absolutely right. Like, we on the sales side expect if somebody says, do you have a rental loan? The next immediate question is, well, what's your rate? So the real way that we have to answer that is there's a lot of variables and factors that go into an interest rate. And again, we want to make sure that we're structuring a rental loan product that fits your business plan and is what you want. So here's some of the factors that can affect your interest rate. First is your credit score. A couple of things about credit score in the rental world. Every 20 credit score points on an even number of, call it 620 to 640, 660, 680, 700, and all the way, up that ladder, has a little bit different pricing in what's called the secondary markets. The bottom line is it's just different rates and better rates for better credit score. For the most part, once you're over a 740 credit score, you're in the upper echelon. There's not much better than that. So 741 to an 800 doesn't make a big difference. But credit score is number one. The second is leverage. Leverage has a similar sort of ladder effect in regards to every 5% of what we call LTV. So your lowest bucket is 60% LTV. Anything under 60 will get you the lowest rates, but 49 versus 60 isn't going to be different. But every 5% above that is. So 60 to 65, 65 to 70, 70 to 75, and then if available, 75 to 80%. The higher leverage, the more risk it's perceived to the bank. So there's higher rates with higher leverage. So that's another factor. Another couple quick ones is your loan amount size. The larger the loan, typically, the lower the rates. So we here at Lima One can package up portfolios. And so at times it can make sense to package deals up to get a higher loan amount to get a slightly lower rate. And then your debt service coverage ratio can also have a little bit of a factor. There's sort of like a binary approach to that. Where if it's in the upper echelon, it's just slightly better rates. But then the other important one is your term. So without going too deep into capital markets and secondary markets, mumbo jumbo in that regard, your shorter duration terms are going to have the lowest rates. And so what is a shorter duration term? Here, it's a 5-1 ARM. So that means that it's a 30-year amortized product, but it's fixed for 5 years and it can adjust after. Well, a bank knows that they only have to guarantee that rate because it can adjust after for 5 years. That's less risky than a 30-year fixed. So typically, the longer duration, the longer fixed period loans of like a 30-year fixed are going to have slightly more expensive rates than the shorter term fixed because of that perceived risk from the lender. So I think I probably covered plenty of the bases on how you can affect rate. But the last sort of piece of guidance that I'll give here is there's a lot of variables, as you can tell. You have to compare apples to apples. We and our sales reps are absolutely trained to do that. So please use us for sort of the consultative approach because this is what we're specialists in. But a 60% LTV versus 70% LTV is apples and oranges. If you tell somebody your 660 credit score and you tell the other it's 720, it's, again, bananas and another fruit that I can't think of right now. I think you get the point. So make sure you compare apples to apples. You're giving consistent information to multiple lenders if you're comparing, and help your lender help you make sure that you are comparing apples to apples as well.
Hey, a masterclass in rental interest rate education. I love it. Thanks, Nate.